Even Elon Musk is afraid of this. I'm your host, Steven Van Metre, and thanks for joining me today. And with the government setting its sights on billionaires, it could have serious repercussions for the stock market at the worst possible time. Let's pick this story up, where the Tesla CEO retook his title as the richest person in the world in late 2021 when he passed Amazon's Jeff Bezos. And when asked, quote, how do you feel being at a net worth of $260 billion, roughly perceived as the richest person on earth? Well, Musk responded, I do think that Putin is significantly richer than me. But what does this have to do with anything? Is that Biden is going to propose a 20% tax aimed at billionaires' unrealized gains, and that's going to have a significant impact on the stock market. President Joe Biden will propose a minimum 20% tax rate that would hit both the income and unrealized capital gains of U.S. households worth more than $100 billion as part of his budget proposal to be released today. Now, could you imagine being taxed on your unrealized gains? I mean, could you imagine going through tax time and having to calculate what your unrealized gains or potentially losses were and having to factor that every year? What a mammoth undertaking that would be for perhaps just the average person. But factor someone who's a billionaire who has probably lots of different assets. Well, it could be a very expensive process, not to mention the tax bill. The plan, called the Billionaire Minimum Income Tax by the White House, represents the most aggressive proposal by the administration yet in Biden's efforts to increase taxation on wealthiest Americans. If enacted, the tax would generate an estimated $360 billion in new revenue over the next decade, representing more than a third of the White House's projected $1 trillion cut to deficit spending over that period. Now, you might be wondering, but what could this have to do with the stock market? Well, you're about to find out, because those who fell under the new law would be required to complete a process called mark to market, where they provide the Internal Revenue Service with detailed accounts of how much their assets gained or lost in value each year. Under Biden's plan, households worth more than $100 million who do not already pay 20% tax on their so-called full income would be subject to the additional tax. The administration projects that more than half of revenues for the new payment would come from the nation's roughly 700 billionaires. Now, think about this. How many billionaires out there have much of their net worth in their company stock or in the stock market? And if they're being taxed on their unrealized gains, what would they have to do? You got it. They'd have to sell. They would become forced sellers to liquidate some of their stock to pay on unrealized gains. And that could have massive downside risk. Perhaps when the stock market goes illiquid, that all these billionaires may be forced to sell at the same time to meet their tax bills. In effect, the billionaire minimum income tax payments are a prepayment of tax obligation these households will owe when they later realize their gains, the White House said. This approach means that the various wealthy Americans pay taxes as they go, just like everyone else, and eliminates the inefficient sheltering of income for decades or even generations. But it doesn't end there. Senator Bernie Sanders is proposing to tax some profits on the largest U.S. corporations as much as 95% in a new bill that would seek to collect more revenue from the largest U.S. companies, including JP Chase and Chevron, that are earning more than they did before the pandemic war in Ukraine. So now tack on, you've got a billionaire minimum income tax and a high corporate tax rate targeting just a few of the biggest corporations out there. Sanders said that Chevron would have owed an additional $12.9 billion in taxes under its proposal based on the oil company's profits last year. JP Morgan would have owed an extra $18.8 billion, he said, and companies would pay the current 21% corporate tax rate on earnings up to the amounts they recorded before the pandemic, and then have to pay a whopping 95% rate for profits above those levels. The total tax is capped at 75% of a company's income in a single year. The levy would apply to corporations with at least $500 million in annual revenue, and you could only imagine how the stock market might react to the fact that not only are these billionaires now having to force sell their stock when they have to meet their tax bill, but what would happen to company profits if they're being taxed at a 95% rate above the amount they made before the pandemic? And that would be disastrous for the market. And you start to think about people like Elon Musk, And what's going on here is the economy is showing signs of weakening. So imagine now they're selling stock now to meet some gains. And all of a sudden, what happens if the stock price starts to head lower? Well, the probabilities of that are much higher than you think, because today alone, the 530s briefly inverted. And that's a harbinger for a recession. Of course, if you're concerned about a recession for your portfolio, well, you shouldn't be. Be sure to check out Portfolio Shield. I'll put a link up there in the corner of the description below. You'll be glad you did. Let's take a look at this chart here, because here we have the 530s. Now, this morning it inverted, so it's right sitting now on the black line, or very, very close to it as you're watching this show right now. And what that means is for all these billionaires is when the market, when you see these inversions in the 530s, we'll notice how soon the equity market here in red, we're looking at the Wilshire 5000, starts to peak and head lower. And you have an inversion, still inverted, starting to move higher, and there goes the equity market. Here you see an inversion causing that massive double dip between 2015 and 2016, and now look, we're facing an inversion again, and at the same time, we see a potential peak in the market, suggesting now the best of the market is behind us. But for some of these people, it could be a big tax bill coming, and at the worst possible time. Now let's take a look at more evidence the stock market perhaps is going down. Further, is we see this University of Michigan Consumer Sentiment Survey from Friday falling to new lows. In fact, here's the pandemic lows. So people were pretty unhappy then, and now look, in fact, I drew these little red lines across to show you that consumer sentiment is as bad as it is now, where it used to be kind of bottoming during some other recessions, indicating that perhaps sentiment is going to get much, much worse. And this has huge knock-on effects for not only the equity market, but the bond market as well. Let me show you this, because here we overlay the Wilshire 5000 again. And note, as sentiment goes down, well, the equity market goes down. It starts to make a lot of sense when you see these relationships. Here you see it again in the great financial crisis. Here we see it during the pandemic, and we'll soon see it again, because when consumers get less confident, what do? They spend less, and that feeds back into lower corporate revenues, lower corporate profits, and then you tack on perhaps Bernie Sanders' 95% tax rate, and boy, that's going to just devastate corporate profits going forward. But how about the bond market? Because the view right now is that interest rates can only go higher, but consumer sentiment says, well, perhaps that's wrong. In fact, when consumer sentiment falls, here we've got 30-year Treasury yields overlaid in red, and you'll notice when sentiment falls, well, so do yields. And why does that happen? Well, it's real simple, because when people are less confident, they spend less, they start paying off their debt, and that means yields must fall. And why do they need to fall? Well, because what creates new money in our economy? That's right, when people borrow from the commercial banking system. So when you see a strong dollar, well, that tells you financial conditions are tightening, and what needs to happen is yields need to fall to create more dollars. And all consumers are telling you is, hey, we're not confident about this economy, we don't want to borrow as much, and yields fall to entice them back in. And what else is another factor that we saw last week? Well, it could affect our big billionaire CEO, Elon Musk. Well, how about durable goods new orders? Now, these are things like automobiles, washers and dryers, things that you buy and keep for a long time. Well, check this out, because consumer sentiment overlaid against manufacturers' new orders in red, and you see new orders go down when sentiment goes down. Again, it makes perfect sense. Sentiment falls, people stop spending, and you see it again here. We saw sentiment fall after new orders because of the pandemic, but look at what's happening now. You see sentiment falling, indicating that new orders are going to have a substantial drop off, and the simple reason for that is, again, when people are less confident, they spend less, and all of a sudden you see an economic slowdown. So these proposals coming out of the White House and Congress could be really bad at the wrong time, as the economy looks to be headed into recession. And now you know why Elon Musk does not like this, and probably none of the other 699 billionaire buddies. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.